John, I know that we were a little concerned about filling the allotted time. I think we just took care of those questions here. And I don't see, is John also on? All right. So to keep things moving, we're going to turn our attention to a bit of market analysis from the team at Reverse Market Insight. We have with us today, we're lucky enough to have Mr. John Lundy, who's an expert in financial analysis and investment modeling in a range of industries, including reverse mortgage, investment management, real estate services, real estate settlement services, and wireless telecommunication. John draws on deep experience in the reverse mortgage industry and extensive relationships with leaders at top lenders, servicers, and investors in the space to focus on Reverse Market Insight's product development and sales and predictive niches for clients. Prior to founding RMI in March of 2007, John led the business metrics and an analysis team at Financial Freedom Senior Funding, where I had the great pleasure of working very closely with John on some of those numbers. Who'd always remind me that it wasn't he who was making the numbers up, he was just analyzing them. So thank you, John. I do want to mention that John has previously worked at AT&T Wireless, Sendit Settlement Services, and MetaMarkets.com, and holds a Bachelor of Science degree in Business Finance from California State University, San Bernardino. And along with John, we have John McHugh, who is the Director of Client Relations for Reverse Market Insight. John ensures that RMI's clients are getting the exact services that are most beneficial to their individual needs by taking a personal interest in each of them, with particular focus on their current and future goals. By talking to each one individually and customizing a package of services that is just right for their business needs, John is able to help RMI's clients more effectively and efficiently target their marketplace with as little money as possible while increasing their returns. John is a native of Washington State and graduated from University of Washington with his Bachelor of Arts in Economics. I am going to get out of the way and turn this over to John and John at RMI. I thank you both once again for your support and participation, and I'll talk to you again in a few.
Yeah, thanks, Steve. Appreciate that, that great intro. So today we're going to be discussing how to improve HECM penetration rates and why this is important to the industry. So, John, we're going to be talking about, why penetration rates are going down and why this is important. But before we kind of get into that, what exactly is penetration again?
Yeah, so thanks, Steve, and everybody who's with us today. It's always an honor to be part of this with NERMLA and with the whole industry here. So in terms of penetration, we think about penetration, and if you look at the math behind penetration, it's really works like a market share for the entire industry. If we think about how many age-eligible homeowner households there are out there, that's the denominator, and then so from that, how many of them actually have a reverse mortgage in place? And so that becomes a numerator. So it's really a percentage kind of a measurement, again, kind of like market share. So, if we were at 100%, that would mean, everybody that's eligible has a reverse mortgage. Obviously, we're not there today.
So on the next slide here, Daryl, there you go. So kind of the recap of what John just said. So, so John, what would you say are a couple of the core reasons we're seeing this decline in penetration?
Yeah, so, I think when nobody wants to see their market share go down, but when we really start to drill into it a little bit, and again, kind of staying with the math for just a second here, we're seeing both of the numbers involved here move against us. The number of HECMs in servicing portfolios that's been trending downward basically ever since the 2017 PLF factor changes. At the same time that we do still continue to see the number of age-eligible homeowner households go up. So, for both of those reasons, we're actually seeing penetration go down. As we look at the next slide, we can start to think about some of the reasons why that's happening. So, we'll share some numbers in a couple more slides here, but in general, one of the things that's been happening a lot lately and over the past several years is loans getting assigned to FHA. That actually doesn't remove them from the penetration equation. So, if we think about loans exiting the servicing portfolio, yes, they're coming out of a lender's servicing portfolio, but they're actually just transferring over to FHA's servicing portfolio. So one of those big numbers there isn't really reducing penetration, but at the same time, we think about, okay, how are the different other factors that are happening? So we're seeing, very low interest rates right now, sharply appreciating home prices. That it will help serve any reverse mortgage, but in particular for a HECM to HECM refi or any kind of reverse mortgage refinance transaction that really supercharges and creates a refinance boom, not dissimilar to the way kind of the forward mortgage world works there. The big challenge, though, is when we do refinances as an industry, we might shift loans from one servicer's portfolio to another, or things like that, but we're not adding new customers as an industry. We're not growing our market share at all. We may be better serving our existing borrowers, but again, we're not helping to create that more mainstream product awareness and an installed base that really gets us further in terms of becoming a mainstream financial product. So right now, I think John just posted in the chat, we're in the low 2% penetration kind of range. And again, that's down a little bit from a couple years past. I don't think anybody would argue that that's the right place for us to be to really get widespread understanding and appreciation of the power of the product in really serving, as our prior panel was addressing, serving a client niche and a use case that really does exist out there as folks are living longer and most of their wealth is generally tied up in their home equity. As we move to the next slide, we can again see some of that effect as it's happened over these last couple of years. So, the bars or the columns are showing us the average MCA for all HECMs that have been endorsed over the last couple of years. We can see that has sharply increased, general upward trend throughout this whole graph, but a sharp increase over 2020 and in the beginning of 2021 here. And that's also coincided with a pretty sharp increase in the percentage of endorsements that are HECM refis. So we can see that again, part of what's behind this is really, a fundamental force that's out of our industry's control. We're just in many ways reacting to that, and that is those sharply increasing home prices, coupled with again those low interest rates, really, help supercharge this effect.
Okay, well, thanks for those insights there. So obviously, HECM is growing, and that's a large percentage of our current volumes. What do you see the future of this? Do you see this to be kind of a continuing trend, or what are you kind of forecasting if you had to have your crystal ball?
Yeah, so I think, Daryl, if you want to push to the next slide, one of the interesting ways to think about this is to really think about how many potential loans there are out there to refinance. So the line here is showing exclusive of the assigned portfolio, but just from a servicer, kind of a lender servicer kind of a perspective, what is the total servicing portfolio of HECMs out there? And we can see that shrunk pretty significantly over the last couple of years. This takes a little bit longer time frame into perspective, but when we really start thinking about, okay, yes, we're benefiting and seeing refinance activity very similar to the way, forward mortgage, which is a much more obviously mature and higher market share product. If we think about it that way, forward mortgage might be somewhere in the 70-ish% range in terms of market share for our same set of customers. The age eligible homeowner households that might be eligible for HECM, somewhere in the neighborhood of 2/3 of them already have a forward mortgage. So if we were talking about refinancing forward mortgages and not worried about some of the qualification requirements for monthly payment and income, there'd be a huge installed base for that to be refinanced. But given that we're at that 2% rate, it's simply a different story. And so, one of the things to keep an eye on and think about here is the fact that we simply don't have that many loans out there available to refinance. The circle here down in the table shows simply that over the last couple of years here, if we look at just the loans that are at least 18 months old out in servicing portfolios, we've seen that drop by 1/3 over the past couple of years, at the same time that the number of HECM to HECM refinances done has gone up more than 8-fold. So again, we can't see a similar increase in HECM to HECM refinances over the next coming years without a substantially bigger non-refinance origination volume happening, if for no other reason, just simply to support future refinances. So it's simply a word of caution and some numbers to better understand that, frankly, there's not a strongly sustainable high growth number here in terms of the HECM refinance niche.
So besides, us doing less HECM to HECM, which obviously we're in a pretty ideal lending environment, so that might not happen, immediately, even though we're looking at these numbers. What are some other ways we could possibly combat that declining penetration rate that we're seeing?
Yeah, and I think one of the interesting things, or I guess the context that I keep around this, I think the refinances, the HECM to HECM refinances, those in large part are driven a lot by the macro forces that are out of our control. We talked earlier about the interest rates and home prices. Nobody in our industry controls either of those. And so we can respond to those and really, better serve customers if that's with a refinance when those forces change and those factors move around. But I think as we move into the next slide here, Daryl, the other things to keep in mind, the prior panel here, there was a lot of good information about how to talk to financial planners. There are just like in the forward world, there's a little bit of longer range impact that really we need to continue to maintain a focus and a balance. Refinances might be a good short-term activity that can generate volume, and obviously, again, you should serve your customers well. But at the same time, continue some of those longer range efforts that will bear fruit, maybe not tomorrow, maybe not in today's phone call, but continue to lay that groundwork, lay the foundation for your own personal business and your book of business, your local reputation, but also just the industry at large is built and has been built over the 30 years that it's been here, from some of these longer range activities and investments that really help continue to push the industry forward. Another good place to think about is, there are way more, given how much more mature the forward mortgage world is, way more forward mortgage world companies and originators out there that maybe don't even recognize a reverse mortgage situation and use case and customer when they run across it. So being able to leverage some of those relationships, build some of those relationships, and continue to add that balance to your business. Daryl, if you go to the next slide. One of the things that we've continued to see over time is the number of companies involved in the reverse mortgage space is positively correlated with the growing endorsements. So the more companies are endorsing loans, the more active lenders there are, that increases the number of reverse mortgage originations that are happening. That just simply tells us, again, the same thing, that increased distribution, getting more folks at the table, getting more, spreading the word, and really having more companies involved is a good thing. That kind of works both ways. Obviously, as companies see additional volume in the reverse mortgage world, there's more companies are likely to jump in. But again, the important point to note here is at this phase of where we're at in the product awareness, again, 2% market penetration, more companies involved is a good thing. It actually helps everyone involved. Obviously, more loans, it can really help spread the word, increase our market share as an industry, and more companies are helpful in doing that. If we go into the next slide, one of the other interesting things that we notice, even beyond getting more companies involved in the space, if we look at all the brokers out there and think about how they stack up, basically almost 88% of all the brokers over the past year have averaged one or fewer loans per month. And so even beyond getting new companies involved, maybe bringing forward companies into the space and having them start originating, looking at our own low-hanging fruit of companies that are involved enough to have originated a handful of loans, but maybe they're doing it at a really low level. They're not maximizing their opportunity and some of their own distribution internal to their company. Again, 1,800 brokers in the past year originated 12 or fewer loans over that past year. So growing those folks, really looking at those existing low volume relationships as a potential path. Obviously, not all of these are going to step up and join the top tiers of this chart, but even if they move from the 0 to 1 to 2 to 5, 6 to 10 kind of loans a month, that would be very significant and meaningful volume. Obviously for your own business, but also industry overall. And then similarly, another almost 10% of the brokers out there did 5 or fewer, 2 to 5 loans a month. So looking at just those two bottom tiers of volume, we have a lot of potential that again, with a little bit of work, who am I kidding? I should say a lot of work. but we have an opportunity right in front of us there.
All right, great. So we see all the production numbers. We talk to a lot of people in the industry daily. Are there any companies that really kind of stand out to you when it comes to helping us as, and I say us as an industry, increasing our penetration rates by doing some of these things that we're talking about or that you're talking about?
Yeah, it's always fun to talk about success stories, right? So even just among our clients, but even looking across the whole industry, if we look at the next slide here, Daryl, we can see examples where, in the new to reverse, right? Something we've touched on a couple slides here. There's existing active programs, over at Longbridge as well as high tech lending. They're very actively targeting that niche, really putting together programs designed to bring new additional originators and companies into the space. Again, that's a very healthy thing. Obviously, they're doing it for their own purposes, right? But at the end of the day, this actually benefits the entire industry as well. So really a double whammy there. And then on the flip side, thinking about some of those niches where volume can grow and has a lot of potential, HECM for Purchase has been more than a decade now. I know we've been talking about this, but individual companies really have shown the way. If we look at the way they've been able to grow volume, in this chart that we've got here, just showing these two companies as an example, Mutual Omaha and Fairway Independent, both of these companies, even in the face of overall volume declines for HECM endorsements overall, both of them have shown positive trends in the HECM for Purchase niche. So again, places where there really can be some growth, irrespective of what's going on in the environment around us.
Okay. So, we've been talking all about, the HECM product and things that we can do within that H4P, bringing other people into that. But obviously there's a whole nother side to our industry now with the proprietary products. So how do you see that fitting into, helping, give us that additional lift with our penetration?
Yeah, so on this next slide here, there are some ideas. Obviously, we are not an originator, we're not a lender, we're not the ones creating these ideas. But at the same time, we're seeing a lot of really good ideas out there and really new avenues to explore. So historically, in their first iteration, the jumbo product, right? Just really tapping into that niche of higher home values than the HECM loan limits would allow. That was kind of the first incarnation of the proprietary loans in the space. We're now starting to see that broaden out and really become more interesting, more diverse. And that can only be a good thing in terms of helping us get additional borrowers into the space, additional originators, maybe a forward mortgage company that's used to seeing literally hundreds of different product options, really thinking about how to approach more of the potential market out there, whether that's home types, co-ops, condos, other things that maybe don't quite fit the HECM, but maybe are solid collateral for a proprietary loan. And second residences, things that might not have that primary residence requirement that the HECM does have. There's also been these very interesting options that we've started to see roll out where, a loan with a typical monthly principal and interest payment might extend for the first handful of years on the loan, but then automatically transform or convert into a no monthly interest and principal required reverse mortgage. It's a really interesting idea. And as you start thinking about how that can tap into additional customers and additional use cases where it really makes sense to talk to somebody a little bit before they fit into the traditional HECM niche and HECM role, it really makes it interesting. And then obviously, to the extent that those age limits can be pushed down a little bit compared to the HECM level, that only broadens the whole borrower pool. On the next slide here, I think as we look forward from there, I think some of the things that we can continue to learn from the forward business, obviously continue to innovate on the product front. Again, there are hundreds of products in the forward world, many minor variations of different things, but when we really back up and think about it, it's different use cases. Identify customers that have specific needs that can be better met and better suited to specific product designs. So thinking about home improvement or energy efficiency improvements that might help folks stay in their home longer, as well as construction to perm, really branching out from the HECM for purchase and other ideas that have so much potential. These are all things that exist in the forward world, and maybe we can, as we continue to grow and get a little bit more creative on the back end, maybe able to leverage some of those ideas and concepts going forward.
Okay, well, great. So, wrapping this all back up, we've been talking at, industry level and what, the industry can do and what companies can do. But, is there anything you can kind of think of that, an individual could possibly be using or doing to, help bring others into the fold, if you will, I saw some chats earlier about, for instance, financial planners and, people's reluctance to the program. Can you think of other things that, individuals could possibly do to help, bring those people into the fold?
Yeah, so on this next slide, one of the things that we've done as a company, I mentioned before that we are not a lender, we're not a servicer. We really exist to serve lenders, servicers, and originators. And so as the pandemic provided all of us plenty of time to think about different ways we can approach things, one of the things we rolled out was what we call the HECM neighborhood widget. It basically is a simple piece of code that can install onto your website and really helps your website work a little harder for you when you're not in front of your customer. Starts to engage that customer, help educate them a bit, and really provide them social proof around, the reverse mortgage is being done by folks in their area. It'll provide some of that reassurance and confidence, but then even beyond potential borrowers visiting your website and seeing this is also something that works well on a tablet, on a phone, and as you're in a conference or a webinar with financial planners or realtors or other business-to-business kind of conversations, this is something you can pull out and leverage and show, again, just how important and useful this financial product can be to folks that really, they do tend to spend their day thinking about and working through numbers. So they're going to be comfortable and familiar with that. So that's something we offer, something that we try to help our customers with. Obviously, there's a lot of other things out there that can help as well and should be tried. But wanted to make sure that we provide at least one concrete idea, an example here for us.
All right. Well, thanks, John, for sharing your insights on this growing problem and how you see us hopefully fixing some of these. These slides will be made available to NERMA to share. And I don't know if I know we're a minute or so over, but if there's any questions and if we have a second, we'll try to answer any.
I am not seeing any additional questions at this point, John and John, but if we get any, I certainly will forward them to you. I have one question. How can our members and attendees learn more about this widget?
Yes, we do have the last slide here, I guess, is our contact information, and always on our website, you can reach out and we'd love to chat with you a little further and see if this is something that would help. John, you have any thoughts there?
No, I was going to say, just there's our contact info. Just feel free to give me a call. I'll run you through what that looks like and some of the different ideas. So we have clients who are using this with their borrowers. Those folks who happen to be a little hesitant about the product and have some hesitations. Just letting them know. Well, look at how many loans are happening. Let's say in a 10-mile radius around you. How many have been done in the last 12 months? It just gives people peace of mind. And when you're talking to professionals, the thing that separates you from all the other loan officers out there, for the most part, I know we have CRMPs, we got different people with different experiences and different histories with this program, but at the end of the day, most people know how to take an app, know how to send people to counseling, know the ins and outs of the program, and these folks talk to those types of people all day long. My clients who have been very successful in gaining those referrals from these trusted professionals have used this kind of data very successfully to, for instance, with financial planners, helping them understand just how many people are using this in their neighborhoods. And more importantly, that people in upper echelon communities, let's say, right, high valued area, homes, there's reverses being done in Beverly Hills. I was just looking at this the other day. I mean, one of the most famous zip codes in the world. But having them see that it's not this loan of last resort, as Shelley kind of spoke about, I think before, once you get to that point, it's too late, right? And so, having anything like that to help support those types of growth is what I'd be happy to talk to you guys with or talk to you about.
Great. Thank you. Thank you both once again. I greatly appreciate your time and your support and your participation. I will be pinging you for a quick data set in Ohio, but I'll get to that early next week. But John, all the best. Great job, strong work, and we are going to keep moving here.